Let's talk about mastering the overnight swing trade and, of course, the advantages and disadvantages. A swing trade is generally a trade in which you use technical indicators to tell you when to buy or sell a stock or ETF or options, whatever it may be. And that trade could last a day, a week, a month, or even half a year. It just depends on the strategy and the signals you're using. With an overnight swing trade, we're taking advantage of the overnight action after the U.S. market closes. It closes at 4 p.m. Eastern Time and opens the next morning at 9:30 a.m. Eastern. And there's a lot that happens overnight. There's news and activity around the world that creates this gap. And that's what we're trading off of. There are advantages and disadvantages to day trading and overnight swing trading. Day trading allows you to get in during the day and you're out at the end of the day, so you don't have to worry about all the activity that happens overnight that causes that gap. However, you have access to your account all day. And one of the things that really ruins day trading is emotion. And if you don't have a good, solid plan and you can't keep your emotions out of your trading, well then overnight swing trading is not a bad solution. So unlike day traders, we don't have stops, but we can use hedges, which I'll talk about in a few moments. But when we overnight swing trade, we're buying at the close of the trading day, and there's nothing we can do until the next morning. In other words, there's no way for us to mess up the trade. We just have to let the market do what we think it's going to do. And then we'll sell in the morning to take advantage of that opportunity or minimize our losses. To trade like we do with overnight swing trades using options, you need to have a brokerage account that allows you to trade options. Now, I generally recommend cash accounts versus margin accounts, but it doesn't matter either way because it's not considered a day trade when you buy at the close and sell in the morning. However, if you want to buy and sell a little bit after the market opens during that really heavy volume time and do a little day trading, well then the margin account will require that you have at least $25,000 in it to do that on a regular basis, like 3 times per week. So if you want to be more aggressive and more active beyond the overnight swing trade, I would definitely recommend a cash account. Next, you need an indicator in which to trade off of. And there are many indicators that you can use, but different indicators have different time frames, such as a moving average indicator, a 250 moving average indicator would be more of a long-term indicator. Maybe the MACD or a RSI, they're money flow indicators. There are many indicators that you can consider. However, since we're doing a short-term trade, we really only need to know either up or down. And that's why we use the SPY Tomorrow signal over at spytomorrow.com. It shows us on the front page either up, buy calls, or down, buy puts. If you buy calls and puts, you definitely need to consider your position size because if the indicator is wrong or the mood of the market changes, you could easily lose half of your money. Now, if you want to hedge, there are a number of ways you can go about this. We tend to use SPY-T trading, and we have a few variations, such as the SPY-T-A, SPY-T-B, SPY-T-C, SPY-T-D, and the SPY-T-S. Each one has a different level of aggressiveness. For example, the SPY-T-A is much more aggressive than the SPY-T-S. But obviously the SPY-T-A can offer greater rewards, but could have also greater losses compared to the SPY-TS, which could offer rewards no matter which direction the market goes. Although this is an aggressive style of trading, the name of the game is still about protecting your capital. And if you think that the mood of the market could change overnight because there's an economic report coming out or earnings that could affect the market, you may want to protect yourself with a hedge trade such as a SPY-TS or a SPY-TB, or quite possibly not trading at all because the premiums are inflated so much that we could see an IV crush the next day, and it wouldn't matter whether your indicator is right or wrong. So you always have to be aware of what's coming around the next day. You definitely want to test this out before you use real money. In other words, check out the indicators, understand how it works. I would do paper trading, whether on a spreadsheet or using Thinkorswim. There are a number of ways you can paper trade, but I would do that first so you have a good idea of how the market reacts in different situations. Because the market isn't always as predictable as you'd like it to be in terms of how much you will make. For example, today we were right. The indicator was correct, but I only made 13% on a move in which I made about 55% the day before. So volatility does play a role. And so some days in which volatility is in your favor, you'll probably make much more. But if volatility is coming down, you'll probably make less. That also affects the SPY T trades, so you need to be aware of how volatility, as well as the news, is going to affect your trade so you can become a better trader. But there's one thing that will always determine your success as a trader. It's certainly important to know when to trade and to figure out a good entry point into your trade. However, what is more important is learning how to sell. Learning how to sell your options, exiting your trade is going to make you much more money than knowing when to trade and when to buy. And that does take time. And patience is a big part of it. And also using some of those tools that I mentioned. Having a tool such as a moving average or a money flow, something that is a good indicator for you to help you decide when to get out of that trade the next day. The SPY Tomorrow indicator is really designed for the first half hour of trading the next day. That up or down signal, we're saying it's going to be up in the first half hour or down within the first half hour of trading. And if you want to continue to trade, we recommend you get out of that trade within the first half hour and reestablish a new trade based on the signals of the day. As I mentioned before, an advantage of overnight swing trading is the fact that you can't mess up the trade during the middle of the night. You have to let the trade play out until the next morning, not allowing your emotions to get the best of you. However, you do have to exit, as we were just talking about, and good traders are very patient. However, sometimes things don't go right. And when that happens, get out of the trade as soon as you can and do this: nothing. Don't try to fix bad trades. A bad trade is a bad trade, and it's going to happen. I've lost the most money by trying to fix bad trades. Start over and establish a new entry point and exit point if you want to continue on day trading. But get out of your bad trade and just let it be and wait for the next day, because there's always a next day in which you can trade overnight. Personally, one big advantage of overnight swing trading for me is I don't have to stare at the screen all day watching the ups and downs and the pain of every move of the market. I just do one trade overnight while I'm sleeping. And I find that very valuable. Now, that doesn't have to be your only type of trading. You can continue on with day trading or do longer term swing trades. There's many ways to approach it. This can be just one of your trading approaches. But different people have different needs, and overnight swing trading certainly is for those living your life on your terms, having your day free of the pain of the ups and downs of day trading, the anxiety of every market move. I think this is a great way to go. What do you think? Do you do overnight swing trading? How about longer term swing trading? Let me know in the comments below, and I'll see you in the next video.